As of this moment on Sunday, April 19th, 2026, the market is closed for the weekend, but we are coming off a Friday session where Opendoor Technologies, trading under the ticker OPEN, finished at exactly $5.29 per share. This represents a modest but steady gain of 0.38% during the final hours of the week. Now, looking at the screen, you might think a $5 stock is just another speculative penny play, but here is the reality that most people are missing. While the broader real estate sector has been moving at a sluggish pace, Opendoor has actually managed to carve out a massive recovery from its yearly lows of 50 cents. We are seeing a company that was left for dead now trading with a market capitalization back above $5 billion. The tension here is palpable. The market expectation was that high interest rates and a frozen housing market would effectively end the iBuying experiment. The reality, however, is that Opendoor has spent the last year drastically cutting its operational fat and is now aiming for a target of 6,000 home acquisitions per quarter by the end of this year. This gap between the narrative of a failing business model and the reality of a leaner, more efficient machine is exactly why the volatility is so high right now. To understand why Opendoor stock is acting the way it is, you have to look at the institutional activity that has been quietly ramping up. Recently, we have seen major players like Morgan Stanley and Jane Street Group increasing their positions. When the big money starts moving into a stock that is often dismissed by retail as a meme play, it usually signals a shift in the underlying fundamentals. The common ground most investors stand on is the belief that Opendoor is a risky bet on the housing market. I want to challenge that by suggesting that Opendoor is becoming less of a real estate company and more of a data logistics firm. They are using automated property assessments and machine learning pricing tools to turn what used to be a manual, slow process into a high-velocity trading operation for houses. If they can nail the pricing, they win. If they miss by even 2%, the house of cards can shake. This is the tightrope they are walking, and it is why we saw trading volumes spike to over 43 million shares in the latest session, well above their 31 million average. The recent price action has been a classic battle of technical levels. We have seen a very clear support floor established at $4.28, a level that has been tested and defended multiple times this month. On the flip side, there is a heavy ceiling of resistance at $4.74 that the stock finally managed to punch through during this latest rally. When a stock breaks through a long-term resistance level on high volume, it often indicates a shift in sentiment. People who are short are being forced to cover, and momentum traders are jumping in through platforms like the Robinhood app or using interactive brokers to catch the swing. If you are looking at your individual brokerage account right now, you are seeing a stock that is up nearly 5% over the last few days, while many other tech-adjacent stocks are flat. This divergence is important because it shows that Opendoor is starting to decouple from the general risk-off sentiment and is beginning to trade on its own internal catalysts. What is driving this current push is the anticipation of their upcoming earnings report on May 7th. The market is looking for a loss of about 6 cents per share, which would be a massive improvement from the 26 cents loss they posted a year ago. Investors are starting to believe the Opendoor 2.0 model, which focuses on higher margins and slower, more disciplined growth, is actually working. The company recently reported that their October 2025 cohort of home purchases achieved some of the highest margins in the company's history. This is the secret sauce. If they can prove that they can buy homes, hold them for a short period, and sell them at a profit, even when mortgage rates are hovering in the 6 to 7% range, then the entire thesis for the stock changes. It moves from being a speculative gamble to a legitimate online investing opportunity for those who believe in the digitization of the housing market. Let's talk about the business model for a second, because there is still a lot of confusion. Opendoor is essentially a market maker for residential real estate. Instead of listing your house and waiting months for a buyer, Opendoor makes you an all-cash offer, takes the home into their inventory, and then resells it. This is capital intensive and requires a massive amount of credit. In a world where debt is expensive, this is where the fear comes from. However, the company has shifted its focus to what they call contribution profit. They aren't just trying to flip houses for a quick buck anymore, they are looking at the total fee structure and the efficiency of the transaction. They are integrating mortgage services and title insurance directly into the flow, trying to capture more value from every single transaction. This is a similar strategy to what we see with Nvidia stock or Apple stock, where the ecosystem becomes more valuable than the individual product. They want to be the platform where the transaction happens, not just the buyer of the asset. Comparing them to Zillow or OfferPad is inevitable. Zillow famously exited the iBuying space because they couldn't get the pricing right. OfferPad is still in the game, but is much smaller in scale.
Opendoor is the last giant standing in this specific niche. This gives them a data advantage that is hard to replicate. Every home they buy and sell feeds back into their pricing engine, making the next transaction more accurate. This is the AI-driven expansion that management keeps talking about. They are trying to reach a point of adjusted net income profitability by the end of 2026. If they hit that mark, the current price of $529 will look like an absolute steal in hindsight. But, and this is a big but, they are incredibly sensitive to home price declines. A 5 to 10% drop in national home prices would wipe out their margins and put them right back into a defensive posture. Comment below how many shares of Open you currently hold, or if you are waiting for a pullback before you enter. I'm curious to see if the sentiment in the community matches the institutional buying we are seeing. Looking at the broader macro environment, the pressures are real. We are seeing government bond yields stay higher for longer, which keeps mortgage rates elevated. This usually kills demand for housing. However, because so many homeowners are locked into low rates from years ago, the supply of existing homes is at historic lows. This lock-in effect actually helps Opendoor because it keeps home prices stable due to lack of inventory. They are one of the few sources of new inventory in many markets. It's a strange paradox where a bad housing market for consumers is actually a survivable and perhaps even profitable market for a high-volume iBuyer that can provide liquidity where none exists. Institutional demand remains the most telling indicator for me right now. When you see firms like Fidelity or those managing Schwab Intelligent Portfolio starting to look at these small-cap tech names again, it means the appetite for risk is returning. We are seeing a rotation out of the massive mega-cap names and into the beaten-down stocks that have actual paths to profitability. Opendoor has managed to maintain a strong capital structure despite the losses, and that gives them the runway they need to reach that 2026 goal. They are trading at a forward price-to-sales multiple of less than 1, while the industry average is closer to 4. That valuation gap is either a warning sign or a massive opportunity, depending on your risk tolerance. For the self-investing crowd using the SoFi trading platform or the Robinhood app, Opendoor has become a favorite because of its high beta. It moves fast. If the market gets a hint of a rate cut or a softening in the housing data, Open can easily jump 10 or 15% in a single session. This makes it a great candidate for swing trading, but a difficult one for long-term holding if you can't stomach the volatility. We've seen the stock fluctuate between 0.51 and 1087 over the last 52 weeks. That is not for the faint of heart. But notice where we are now. We're right in the middle, trending upwards, with the 20-day moving average acting as a support line. The reality is that Opendoor is a high-stakes bet on the future of how we buy and sell the most expensive asset most people will ever own. The expectation is that the old-school way of using agents and paying 6% commissions will eventually die out. The reality is that this transition is taking much longer and much more expensive than the company's founders originally thought. However, by surviving the winter of 2024 and 2025, Opendoor has proven they have a durable enough balance sheet to stay in the game. They have refined their funnel and are getting better at converting leads into actual acquisitions without overpaying. As we look toward the future, the catalysts are clear. First, the May earnings call will be the primary driver of the next major move. If they beat on revenue and show a narrower loss, we could see a run toward the $7 mark. Second, any movement in the federal funds rate will disproportionately affect this stock. Finally, the ability to scale back to 6,000 homes a quarter without losing discipline on pricing is the ultimate test. If they can do that, they prove the business model is scalable and not just a small-scale experiment. In summary, Opendoor is a stock where the expectations and the reality are currently in a violent tug-of-war. The market expects a struggle, but the recent data shows a company that is executing on a very specific, tech-heavy turnaround plan. The gain to $529 is a sign of growing confidence, but the resistance levels and macroeconomic headwinds remain significant. We are seeing a shift from a speculative meme narrative to a fundamental turnaround story. Whether you are using Fidelity Wealth Management or doing your own online investing, this is a ticker that demands your attention because of its potential to lead the next wave of real estate tech. The authority in this space is being redefined, and Opendoor is currently holding the pen. Keep a close eye on the volume and the institutional inflows, as those will be the true signals in the noise as we head into the summer months. The path to profitability is narrow, but for the first time in years, it is actually visible on the horizon. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.